Ag Economics and Marketing, the panel discussion. The two moderators today, myself, Joel Lemaire, I'm the Adult Farm Management Instructor, office here at the Carrington Research Extension Center. Jeff, if you want to introduce yourself.
Yeah, I'm Jeff Stockler. I'm the Griggs County Extension Agent.
Same procedures as the previous panel discussions, about 50 minutes in length. We're going to give each of our presenters a chance to introduce themselves in a brief summary of their presentation or presentations in some cases. Allow you to ask questions and so forth. Depending on the size of the group, you can either put your question in the chat room. Jeff's going to monitor the chat room. And or if our group is small enough, just jump right down in and ask your questions. We have a CCA continuing ed credit available for this discussion panel, just like the other ones. So we'll make that available to you at the end with the code and so forth. And then hopefully we can put the program evaluation link into the chat box when we get done. We had 6 presenters in this particular section of the Central Dakota Ag Day. 3 of those presenters had some long-term commitments, so they will not be able to join us today. But we do have 3 of them on with us, so we'll go right to them and have them introduce themselves and give us a brief summation of their presentation. Or in Tim's case, he did a couple presentations for Central Dakota Ag Day. And maybe Brian, we'll start with you.
Yeah, sure. So I talked about cow-calf budgets and some of the things that we have going on across the state. And then I gave another presentation, not necessarily for this event, but for the Carrington kind of feedlot school, talking about backgrounding scenarios. So any of you who watched that, I can field those questions as well, because I know that's one of the other things that I wound up with some questions on. But yeah, I'm the state ag finance specialist, and so we put out these budgets every single year, and a lot of what was covered was talking about differences in prices and what we're getting, feed costs and those kind of things. So, and then finally, retaining heifers versus purchasing heifers and how the inventories change. And I guess at the end of it all was dispelling of some myths on retention versus purchase and where a lot of these differences are for our producers in terms of high net income individuals versus the lower group.
Okay, Dave.
Thanks, Joel. Yeah, so Dave Ripplinger, Bioenergy, Bioproducts Economic Specialist with NDSU Extension. I made just a couple of quick points in my presentation, just kind of an update of what's going on in the corn ethanol market, which is like much of the economy has had an interesting ride in 2020. The other thoughts or comments I had were regarding diesel prices and expectations for diesel in the spring, just giving a lot of the different things that are happening in the broader petroleum market and refined products. And then finally, a few comments about carbon and renewable diesel and opportunities that exist right now for folks who already have vegetable oil, but also talking about what it might mean for farmers as that demand for oil itself for those lower carbon vegetable oils, greases, and fats, continue to grow.
Thank you. Mr. Petrie.
Okay, good afternoon, everybody. Tim Petrie, Extension Livestock Marketing Economist. As Joel said, I actually had 2 talks that you may have watched. The first one was about a 30-minute or whatever, 15-minute, I guess, market outlook. And then I also did an LRP, Livestock Risk Protection Insurance. And so I'll just cover kind of both of those at the same time. I did those on November 10th. So keep in mind, we're into another month. And like I ended up when I gave those presentations, said, the market changing daily as it is right now. So I'll give you the month update and then move along. Both fed cattle and feeder cattle have been inching up since since you last saw that in the last month. Cows have basically leveled off. Kind of a tough sell on cows here, and these 2 months they just kind of plummeted from after September 1st, and then we're at packing plant capacity is our dilemma there, and so cows have just stayed the same. So inched up on both fed and feeder cattle compared to last year. Feeder cattle are a little bit above last year, and but fed cattle are still behind. Keep in mind, we've got a smaller calf crop, so the further back you go, the more animals you have. So we have more fed cattle to sell than we had last year, but we have fewer feeder cattle, so that kind of all plays into the mix. But I think on the feeder cattle side right now, to be a and this is, we're talking averages here, more on that in a minute. Got a lot to be thankful for, because in April, we were wondering what's going to happen. And we said we'll be happy if we can get up to, although last fall 2019 levels weren't good, it'll be good if we can get up there. And we did get up there. So just a little bit on what prices have done on fed cattle. We were about at 106 a month ago when I talked to you, and we're up to 111 now. So we're up about $5, but still, $5 to $7 below where we were last year at this time. Again, kind of the big thing on fed cattle is, we do have a lot to sell. The weights are heavier than last year, so we've got record beef production and kind of more to sell there. But we've been inching up, and I think we'll kind of level off the rest of the year. We're into December. The cutout always goes up right now, prior to, after, hams and turkeys are high before Thanksgiving. And then by the time Thanksgiving here, retailers and so on are buying for the holiday, and now they're bought up, and so the cutout's going down a little bit. So on the feeder cattle side, again, these are averages, but we were about at 153 average for the I-94 markets when I talked to you, and we went up again about $5 on them up to this week, averaging about 158. But again, a wide range in prices. Yesterday at KISS for 550 to 6-weight calves averaged 144 to 166.75. That's a $23 spread there from high to low for the same calves at the same market, $130 difference. So it kind of depends on whether you're selling or buying, but that's a big spread there. Then go on to the heavier weight yearling, same thing. We're about a 137 a month ago and up into the low 140s now. So again, up about $5 on them. But again, yesterday at KISS for 750 to 8-weight, the range was 136 to 145. So it all depends on quality and shots. And there were some 700-pound steers yesterday at KISS that we're not weaned yet, or we're just off the cow, so that does make a difference. And on the cow side, again, about the same. Livestock risk protection insurance, been doing a lot of education on that, and again, I talked to you about a month ago, and we were up. But I guess we could do about 138.50 on that one I showed you last time. Would have been the high price that you could lock in, and cost you about 337. And I'll just want to talk a little bit more about the one today. But the big thing on livestock risk protection insurance is, if you've looked at it before, for many years we had a 13% subsidy, which wasn't very big, and I think caused a lot of producers not to use it. But now those subsidies have been increased several times in the last year. The most recent one, as I told you last time, or on the presentation, they're up to a minimum of 35% at the 95 to 100, and then they go all the way up to 55%. And then if you're a beginning farmer, you get 10% more. So yesterday up until 9 o'clock today, got to get my glasses here because this screen is small, but we yesterday could have done 140 was the high at a 389 premium per hundredweight. Again, when you start looking at that on a per head basis, it gets up there plenty. But what I tell producers, you need to know your break even, and you don't have to get that high price. Everybody says, well, I need to get that high price because I got a better chance of getting paid. But that isn't the way to look at insurance. We buy insurance for protection against catastrophic events. So my thought on insurance is, know what your break even is, and then go down and talk to your banker, but make sure you cover your costs there. And so, if your break even is down closer to 130, or you could, yesterday till 9 this morning, you could have got over 132 of kind of a floor price there, and it would have cost you $1.84 a hundredweight, so you could cut your premium in half there. So, encourage you to look at LRP. We're going to have a volatile market. The market has been volatile. We don't know what's going to happen into the future. And by the way, now we're into March 3rd. So the one that comes out this afternoon, you're into March 4th. And so, we're talking over 600 pounds in most cases there. So that's it. Probably already talked too much, and we'll open it up for questions.
And once again, if you have any questions, either type them into the chat box and Jeff's going to monitor those, or, we're a small enough group, you can feel free to jump right on in too. I have a question for Brian. You pointed out that the big difference between the high 20% profitable ranchers, beef cattle producers, and the low 20%, 40% was feed cost. And you really didn't have the time to get into any detail there. What's the big difference in the feed costs? What in your mind is determining those differences? Up to $200 in some cases per head.
Yeah, and that was in the introduction when I was kind of introducing myself. That was kind of the takeaway, and I was actually surprised, to be honest with you. I went in there expecting to see a bunch of maybe so and so is a better marketer, somebody's paying too much for replacement heifers, etc. Wasn't the case at all. And if you do the inventory adjustment, like you guys do with the FBM instructors and everyone when they put this in, really the guys who are retaining are paying the same, which makes perfectly logical sense for somebody who's buying their heifers. Because if you price it out for what you could have got them for at the sale barn, I mean, it's the same difference. So anyway, yeah, it was in the feed was the interesting thing. There's a lot of little things. Okay. You might say that the weaning percentage is maybe a tick lower, a percent lower in the bottom 20%, or that their calves are a hair smaller, but it wasn't any big flashing sign, to say that, hey, this is the reason, except for these feed costs. Being $200 a head is a lot. I mean, that's the entire profit margin in some cases. So I think a lot of it might come from situations like when in a drought situation, for instance, or drier years where guys are forced to buy more feed or something like that, and could explain some of it away. But I think other areas are just simply that what kind of feed are you using? We don't have, it's hard to get into the deep weeds without looking at everybody's balance sheet to see where their feed sources are coming from. Is it silage in the wintertime? Does so-and-so have more grass, cheaper grass, access to lower cash rents, things like that. But by and large, though, I think the key takeaway from my talk was that if you're having a hard time and your neighbor's not going to let you look at their balance sheets to see what they're doing versus what you're doing to figure out why, the first place I would look based on this information is your feed costs. I mean, that is... And is there anything that you can do? I don't want to make some claim that guys, but maybe thinking a little bit outside of your tradition. Maybe you've been doing something a certain way. Those feed costs are, I guess what I would say in the end, if I was advising on it, is we maybe year after year we have to reevaluate where our feed is coming from and what we're doing. Simply because the cost of hay, the cost of grain, the cost of forage may change, year over year, and it does change. The commodity prices change. Go look at the cost of alfalfa hay, and that's tracked by the USDA, and it can change month to month. So maybe just because this was your ration last year, maybe you need to rebalance your ration this year to better reflect what feed costs are doing, and taking stock of what's cheap and available relative, right? What's cheap and available, and what's more expensive, and not just say, well, I'm always feeding this ration of forage and this ration of grain, and come hell or high water, that's what I'm going to do. Maybe we need to do some rebalancing every year to try to keep those feed costs down.
One thing it'd be interesting to look at, Brian, is probably the efficiency of their feeding process. How much of that feed is actually getting consumed, and how much of the feed is actually ending up in a manure pile? That's
an excellent point, Joel. So on my own family's farm, we put cattle out in corn stalks, And for years and years, when I was young, we unroll a bale of alfalfa right there on the ground. You cut the twine, put the bale deal in there with the two prongs, drop it on the ground, and just unroll the thing. Well, once a week, I had to go in there with a loader and clean up manure, infested alfalfa that they're not going to eat. I mean, if it sits there for a day, they're not going to eat it anymore. And so then when we bought a hay buster from good old North Dakota, but an actual hay buster, and ground it and put it in bunks. And then we only had to go down about once, maybe twice a year to clean up all that stuff. So that's a lot of lost hay that the hay buster paid for itself in relatively short order, is my point. So that's a great point, Joel, that things like that we can look at doing. How efficiently are we getting feed from our storage facility or whatever hay pile into the belly of our livestock, and how much waste is there in between? And that's a good thing to say. And I just use the hay buster example because that's one I know personally where we were wasting a lot of feed, and alfalfa ain't cheap. And all of a sudden we had very little waste. I mean, we went from cleaning up a bale a week almost to cleaning up maybe 2 bales the whole winter. So that's a big difference.
Yeah, we see that in the adult farm management world when we start looking at inventory changes and how much feed was actually fed, especially hay. And it's mind-boggling how many pounds per cow that works out to. And there's no way possible that cow can consume that much. The other thing that, I don't know if we could actually track this or go back and find the information, but there might be some differences there also with some of these high profit farms is, what size cows are they running? And we got so many producers now, 1,400 pound cow is just so commonplace compared to 1,100 not just too long ago.
That's a basket of snakes, Joel, that Tim and I have, and Dr. Stucca as well have talked around for now a couple of years, and we keep saying we're going to do something on it, and we never do. But Feral Cattle puts out a paper, the newsletter or whatever you want to call it about that Feral Cattle company out of Colorado. Maybe you've heard of them. But we've talked about that it should be measured on what I would like to do is create a metric that's pounds of beef produced per unit, not pounds of beef per acre, but pounds of beef per, maybe let's call it AUM that you produce. Because AUM is going to be kind of a universal metric, whether you're in a place where the stocking rate's 1 pair for 20 acres, or like Mississippi, where I used to work, where it's a pair for 2 acres because it's more grass. But pounds of beef produced per AUM, and I think what you would find, this is my hypothesis, is that, well, and Tim brought up the point, if you've got a 1,500 pound cow that weans a 550 pound calf versus a 1,200 pound cow that weans a 550 pound calf, how do we measure feed consumption? We measure it by animal unit, right? And so if we keep that constant, that animal unit thing, and say, okay, it's still 1,000 pounds or whatever, then how many pounds of calves or how many animal units do we have, and how many pounds of beef are we actually selling in the fall, or if we background in the spring? And that's important. And I think you're right. And then there's other problems to it too. And if you talk to Dr. Stuck about it, or bring it up, the heavier these animals are, the more feet problems you get. The more leg and joint problems. That's been the problem with bulls for years, is they're so heavy, they wind up hurting their foot or a joint or something after 2 or 3 breeding seasons, and they're washed up because they can't get around anymore. And then they look skinny because they won't eat and they won't do their job. So yes, that is a very, very important concept. But I don't know how much of the industry has or would buy into it.
Right.
Because it's always been bigger, bigger, bigger. If I want to wean a bigger calf, I got to have a bigger cow. That's been the trend forever. But if we could get to a point where we just say, look, I'd rather have more cows and wean smaller calves than having these great big ones. Well, that I think that's true.
Yeah, the other part of the puzzle there that we've ran into is we have efficient 400 or 1,400 pound cows, and we have inefficient 1,000 pound cows. So you got to, it isn't a blanket statement that the bigger the cow, they're they do eat more, but if they wean more pounds, and even different cows are more efficient than others. So that's a real dilemma when we start trying to figure this thing out. Is, like I said, we need efficient cows no matter what weight they are, and so then you need to know the weight of your cow and keep track of the weight of the calf. Like if I said for many years we should have a bull EPD that's based on cow weight and versus the weight of the bull, and Ryan said it very well. I was at a market here a while ago, and they brought in 2 beef cows, and the average weight was 2,000 pounds. So those are big cows, and so they better have a pretty big calf in the fall to pan out.
I mean, when you think about it, Joel, it wasn't that long ago when I was young and 1,000 or 1,100 pounds was a typical cow or less.
Right.
But we weren't weaning 250-pound calves. Okay. We were weaning, 400, 450 up to 500-pound calves. So in other words, the calf was roughly half the weight of the cow that bore it. Right.
Right.
Now that is not the case at all. At 1,500 pounds, how many people are weaning 750-pound calves in October, November? Nobody. So that's what we're losing right there. And if you replace the weight that you're losing in large cattle with more cattle, you're better off. I mean, we can show it mathematically that you're better off if I can add another dozen cows to make up for the lost, let's say 1,200 pounds, 1,500, that 2,000 pounds of calf, then it makes perfect economic sense.
All right, Joel, we've got some questions that have come in now. Dave, this question is for you. This might be asking you to look into the crystal ball too much, but how do you think Biden's environmental policies affecting ethanol use, and how do you see COVID affecting ethanol, and how do you see these two things intersecting and affecting corn prices?
Well, it's a great question. I look forward to using the rest of the hour to answer it.
Go for it.
Yeah, so we don't know exactly what to expect with the new Biden administration. He's actually getting pulled from 2 places, kind of a moderate stance and a very progressive stance on a number of issues. And it does extend to fuel policy and biofuel policy. And right now, we really don't know exactly where he's going to go. There are 2 issues that he has to deal with immediately. The first is some outstanding work that the EPA has to do regarding past waivers. So there's a few billion gallons worth of waivers that Biden could reassign to oil companies, which would be very bullish for biofuels generally. Don't know if he's going to do that. Also, the Trump administration just punted on making setting the numbers for next year for biofuel obligations. And we don't know exactly what the incoming Biden administration might do with that, but essentially they're going to set those numbers. And I would think they do it quickly, but who knows? And I would say that that's a relatively bullish thing as well. Longer term, the bigger question when it comes to environmental policy is clean fuels generally. And so this is the idea of how do we power vehicles in the next 5 years, 20 years, 30 years, and what role do biofuels play in that? And that's where it gets really interesting. And a lot of that might not come to a head during the next 4 years, but that path could be set. And really what we're seeing right now, and maybe to take a clue from what's going on in California, they have a low carbon fuel standard in their state. And they are seeing monstrous demand for biofuel, including both corn ethanol and renewable diesel, which I mentioned during my presentation. Actually, the biggest growth in use for corn ethanol is in E85. There's a huge incentive to reduce the carbon footprint of every mile traveled. And the easiest way to do that right now for passenger vehicles is actually E85 for those folks who are lucky enough to have them. And this doesn't make me overly optimistic about how big E85 would get in California or even nationally. but it demonstrates of how these different policies can distort or change the market and what it does. And then the same is definitely true for renewable diesel, which has a huge premium, and that's being pushed back through the supply chain to those folks who have low cost oils and grease. And then, and everybody's looking for that, not only what's available now, but also what could be produced in the next few years. And that's almost an insatiable demand just for California. And those are pretty optimistic. COVID in terms of ethanol, I'm gonna make a statement, and maybe Brian especially disagrees with me. I think that the impacts of COVID, the immediate impacts of COVID on fuels and on much of the economy is kind of known. And now it's really, is there going to be an economic retraction in the first quarter as a lot of federal support ends? And to me, it's a different issue. It's not necessarily a public health issue. We kind of know, and fuel use has been really stable since April, May, at about 90% of it was a year previous. But if the economy goes into, sees an economic decline or an actual recession, that could impact things. But I think that has so much more to do with Congress and the new administration, as opposed to this actual the pandemic and the public health issues associated with the pandemic. It's a really interesting time, and I think that in general, there's a lot more. There's a whole lot more certainty now than there was in March, and even in most of these markets. We're sitting here, and it's like there's a lot of uncertainty, but we've been dealing with uncertainty in transportation fuels, like a lot of agriculture. There's just so much more now than there was 15 years ago, and so it'll be interesting to see where things go. There's a lot of differences of opinion. You'll know a lot in terms of the Biden administration, depending on who he nominates for the EPA. One of the leading candidates is Mary Nichols, who is the head of California's Air Resources Board, which oversees their clean fuel policy. I'm not sure she'd make it past actually be confirmed, but that would be a strong signal that he's going to be much more progressive. Other potential nominees, maybe not so much. And just looking at, how this might affect corn prices, right now it's not enough to actually move things. I mean, it's not the driver. The corn ethanol folks are trying to stay in the money, and high corn prices are not being caused by them. They're the recipients of it, and they've only got so much more support that they can give, or even be in the market where if these prices rise another 10 cents, or so, you're going to see corn ethanol production, their use of corn decline, because some of those marginal facilities, which could be anywhere, might actually, shut down for a little bit.
David, another question came in about ethanol production affecting DDG production availability for feed. How's that going to happen there?
Yeah, so I mean, the relationship is pretty fixed. If I put a bushel of corn in the front end, I know how much distillers grains I'm going to get out the back end. And again, we've had relatively consistent crush and relatively consistent distillers grains production. The price of distillers grains is, about as high as it's ever been, because it's competing with high cost corn, or relatively high cost corn. And so right now, I would think that, distillers grains availability is going to be there like it is right now. So again, probably 90% of what we had a year ago, just because of the demand for ethanol. And I think the bigger concern is actually the price of corn, because that price of corn is, going to be a signal that, it's scarce, and it's going to make distillers grains scarce as well. And so, you'd see that simultaneous, you'd actually see less corn going into crush and less distillers grains coming out, and then it would have to be balanced somehow.
Okay, another question is the MDGs from local ethanol plants. This individual is saying they can't get it unless it's contracted. Is that because of COVID or other reasons?
That's a great question. I think a lot of the wet and the modified, you can't really have a spot market for that, because if no one's going to accept it, you've got a mess of colossal proportions that no refinery is going to deal with. The folks who get set up well are those who are a consistent customer of modified or wet distillers grains, again, depending on that time of year. but they're the folks who have to be there on time every day, and then just that proven customer. And those folks have done, those folks who get positioned that way. And again, it depends a little bit about, having the right sized operation and being right in line, they've done well. But, to just come in spot on one day to hopefully get some, modified or wet distillers just isn't going to happen, because they can't risk that stuff not moving. And again, they don't want, why would they, set themselves up to having to have a fire sale price, or even worse, impact operations. And again, the one thing you never do in managing a facility like this is you never shut down because of things like that.
Okay, thank you. Question came in here, Dave, that Spiritwood and Blue Flint quit selling DDGs and modified GDs unless you had a contract. Did they oversell?
That one I can't speak to specifically. I would go back to my previous comments about modified. The other thing too is the price of distillers grains is high. The price of corn is high. And so I wonder if they haven't, found buyers for a lot of that.
Okay, thank you. Joel, those are the questions I have at the moment.
Okay, thank you, Jeff. Dave, you mentioned in your presentation about the Dickinson processing plant that was being converted. Could you give us a little more detail on that?
Yeah, absolutely. So during the boom, a smaller oil refinery was built in Dickinson. It was bought out a few years ago by Marathon, which is, the largest integrated oil company now, kind of a piece of trivia there. The facility was small and somewhat out of place. The idea was that they would refine Bakken oil, North Dakota light sweet, and much of what was produced would be used in the region. And the economics were just really tough. There's a lot of enthusiasm, but really tough. Marathon, kind of looking forward, recognized an opportunity to produce renewable diesel. And so now this is a liquid transportation fuel that has characteristics, specs that match those of diesel. So there's no blend wall. The gelling issue isn't there, but it can be a relatively costly process, and one that's very much capital intense. And so right now what we've seen, and Dickinson is actually at the forefront, so it's an opportunity for the state, is they're recommissioning that plant right now, if they haven't actually started producing renewable diesel. And it's a great opportunity. Again, there's tremendous demand for low carbon fuels, especially in California, where that is going to go. That pushes back, makes use of this excess capacity, and then provides a home for vegetable oil, grease, fat. I will let you know that is not coming from North Dakota right now, because we do not have the supplies. It's also worth noting that canola renewable diesel is not an approved pathway for EPA. So if you're optimistic about having a new home for canola oil, renewable diesel won't be it, at least for some time. I do know that the national canola growers are working on that, but it's an interesting situation that they don't have an approved pathway. The expectation is that the amount of renewable diesel production in the next few years is going to grow tremendously. First with these existing refineries, which is fantastic because we have excess petroleum refining capacity because of COVID and the decline of passenger travel, freight transportation. And so we're seeing a lot of those facilities that have been idled, targeted for conversion over to renewable diesel. We're also seeing REG, which is the nation's largest biodiesel producer, looking to put some of that same technology at their existing biodiesel plants. The economics are so much better. Again, because that carbon footprint of renewable diesel is smaller. But again, sitting here, with Dickinson being here, it provides a really neat opportunity for a marriage between agriculture and energy. And it'll be interesting to see exactly how that might impact a potential new crush facility in the region, and also and possibly growth of other oilseed crops. Again, we've gone from this, and I think it's still true globally. The thing that's pushing crops is protein, right? And we always say it's protein in Asia. So it does drive so much of what we do, including in North Dakota with soybeans going that way. The last 6 months, it's been all about vegetable oil. And we can grow soybeans here well. We can grow canola here well. There's some other minor specialty industrial oil seeds that haven't been produced. And it makes a lot of this very, very interesting. And it'll take a little bit of time to see, what this means in terms of new crush and then possibly a change in the crops that we grow in the state.
Okay, David, another question here. This Spirit Wood and Blue Flint that was asked earlier, is it possible that they're short on corn at those plants?
Not that I've heard. There's corn is expensive, and being expensive is the same thing as not being available. You can take a little bit of the clue from the basis that they're paying in terms of trying to get that corn into the plant. And I apologize, I haven't looked at what their basis has been the last few weeks. I do know in Cass County at Thoroldson, they had an abnormal basis about a month ago trying to move corn.
All right, Joel, those are the questions in the chat box at the moment.
I got a question.
I think Washburn was 30 under today.
Yeah, and that's pretty close to normal.
Yeah.
I have a question for Tim. In your presentation, Tim, you talked about low calf numbers and low cow numbers. And the trending up. You mentioned earlier in the discussion panel here that we're seeing those feeder cattle prices start, move up a little bit and so forth. Are we ever going to see another 2014?
Never say never, but it's something we can tell our grandkids about, and likely not. All the stars came together in 2014. We had low pork production because of PD virus. We had low chicken production because of avian influenza, and we just decreased the cow herd 8 straight years. 4 of those not for economic reasons, but for drought. So, could we have disease? And by the way, half the beef cow herd right now is in an area of drought. Yeah. And that's very concerning for next year. Probably some of the other speakers have talked about that, not only in North Dakota. Just go a line from Fargo down to Texas and everything west is dry. That's half the beef cow herd. So we did not likely increase the beef cow herd this year. In fact, it probably went down again, and concern for next year. So, that would be positive for prices, but not for ranchers that have high priced feed and maybe have to depopulate and so on. But yeah, we peaked out the beef cow herd a year ago, and it's by January 1st of this year of 2020 went down and be going down. So lower calf crops are supportive to prices. And like I said before, we're seeing that more, and the calf prices have been more resilient than the yearlings, and even more so than the fed cattle because of those numbers. But we're likely going to have lower calf crops the last couple of years in the US. That's not the case in North Dakota. Actually, we were one of the few states last year that continued increasing beef cow numbers. I don't think we did it this year though, because I think we're about at capacity anyway, and then with the dry weather.
Okay, I got another question for you, Dave. What are your suggestions to our ag producers to take advantage of these diesel fuel prices? I mean, should they go out and buy a big 10,000 gallon tank and fill it up, or should they try to contract? Or
yeah, well, I mean, in general, I mean, the bigger thing that's happening right now is the almost complete lack of activity in terms of air travel. And so that's not going to change. So the relative price of diesel is going to be low among those, those other thing compared to gasoline and jet. The problem is I'm not going to, I think I put myself out there far enough guessing what might happen in Washington. I have no idea what's going to happen elsewhere. And so if we happen to have a skirmish with Iran, we could see really high prices. And so I'm not going to necessarily that, but I mean, just in terms of those relative prices, those types of things are expected to persist again, that we're going to have ample diesel supplies in the country. And again, I don't see many reasons why the price of oil would increase substantially. And that would be the primary driver in this. And again, the state could really use, and while we might not want to pay it as buyers of refined products, the state could really use $60 oil.
Right.
I'd like to make one comment too, actually going back to Sarah's question just understanding of how the RFS works. And so there's different types of biofuels and different requirements for each type. And it's important to note that even though, we might see an increase in the numbers required for what we call just this conventional renewable fuel, which we kind of think of as the corn ethanol bucket, higher value biofuels, so those with a smaller carbon footprint, can fill that as well. And so what we've seen in the last few years is we've actually had excess biodiesel production, to in excess of what's required for that bucket, and that can spill over into the corn ethanol bucket. And so I don't know exactly how things would have to move. And again, we see tremendous demand for biodiesel, renewable diesel. So production of those is going to go up. So the new administration would have to increase that conventional biofuel bucket a bunch, which they can do. And they can also increase the biodiesel bucket substantially. Again, that would really be a change in policy, but it would be extremely supportive of biofuels. Again, I think the bigger question is, what does the administration want to do for clean fuels in general? And which goes back to biofuels or liquid fuels versus electric cars and everything else. And that's going to be another fight. Again, there's differences of opinion depending on who's in the room and in what part of the country they're in. And so clearly, so for some, it's all about electric vehicles, which are still going to take a number of years to really have significant market share. But in the meantime, we might or might not see significant policy support for biofuels, beyond what we're already seeing in California.
Okay. We've got another question that come in. This is a little off topic, but see if either of you three can answer this. The question is, does anyone have any thoughts on fertilizer prices and where they are going?
Yeah, that's Brian.
All right. Yeah. So I've given a few talks on that this fall, actually. And right now they've been pretty low this fall, with the exception of phosphorus, but anhydrous and all other nitrogen fertilizers have been well below their 5-year average. Potash is well below its 5-year average. It's almost bottomed out. And phosphorus is below its 5-year average, although not as dramatically as the others. My thoughts are that fertilizer prices really don't have anywhere to go but up. Now, I'm not saying that they're going to shoot up this spring, but right now this is as low as we've seen on like at least anhydrous in the last 10 years. This is as low as they've been. And same thing with organic matter type fertilizers. So I've been telling folks, this is a good time to pre-price because I just don't think there's any downside to prices heading into the spring, that they're about as low as they're going to get, because fertilizer now is a globally traded commodity. Okay. It didn't used to really be that way. And you used to be able to pretty much benchmark nitrogen, at least, to the price of natural gas, because that's the chief input in producing it. That's where they get the nitrogen, some of the other gases for it. So that's not true anymore. It's almost decoupled from that as a. I'm not saying it doesn't matter. It's just that the correlation's not as strong as it used to be, because if fertilizer gets cheap enough, they ship it overseas. They export it. And then if fertilizer gets really expensive, then we import it, just like any other commodity kind of a thing. So the reason I went into that long-winded diatribe there is just to make the point that once it gets to a point as low as it is, for instance, right now, there's just not a lot of reason to expect it to go lower, because companies like Coke and CF and whoever, they're going to send it overseas. They're not going to take this really low price for it. They're going to export it. And I know a lot of that because my brother's actually a fertilizer trader for Farmers Cooperative, a huge co-op out of in Nebraska. So anyway, that's my spiel on fertilizer, that it's about as low as it can get right now. I won't say that you can't knock another $10 a ton or something off of it, but in terms of if you're worried about pre-pricing because you think, well, I want to see if there's going to be a big 30% decline coming. I highly doubt that. I think that it's either going to hold even or increase as we head into planting, and it always does increase during planting to an extent. So there you go.
Thank you.
From what you guys have been telling us, we've got potentially low fertilizer costs if we take advantage of it. We've got very low or very reasonably low diesel fuel prices. We've had a fantastic harvest season, a fantastic fall. So everybody's got all their work done, all their ditching done, and all their sloughs dug and rock piles buried and everything else. And we're looking for, we're in great shape for spring, except for one problem.
Rain.
Rain, yeah, right. We are dry. Tim alluded to it earlier. Otherwise, it's shaping up good if we can just get some moisture.
I haven't been here long, but this is the first fall where I've been able to, there's no snow.
Right. I was out at a farmer's place yesterday and asked them what they were doing. They were burying rock piles. He said they went down 18 feet, dug a hole 18 feet deep to bury this one rock pile and didn't see any moisture anywhere. It was just bone dry, he said, all the way down. About 5-6 weeks ago, I was out to another producer's place and they were digging in some water lines and some sewer lines, and they were trenching 11 feet deep, and they said there was nothing. They couldn't find any moisture there either. So yeah, it's extremely dry, as Tim alluded to.
And we had a call this morning with our weather guy, Adnan Accuse, and he said that not only were we in the top 10 for dryness this fall, but much warmer, and so there's more evapotranspir. Easy for me to say, more evaporation. And so we had a double whammy, warm, and it's still warm. It gets above freezing during the day. And right. So in terms of soil moisture, no rain and warm, and that's really has hurt the soil moisture profile.
And the thing that I think is going to really catch up to us in spring is we don't have any subsoil to rely on no more. I mean, we've used that up around here anyway. We've used it up the last couple of years, so it's going to take all new moisture. Our time is about up, but we'll show you the contact information. I believe every one of our presenters included their contact information with their presentation that we have online at Carrington Research Extension Center. So you should be able to find their contact information there as well. Jeff's hopefully can pop up the code for the CCA credit.
There we go.
We'll just leave that up for a few minutes, and then at 2 o'clock we'll be starting the next panel discussion. Thank you again, Tim and Dave and Brian.
Thank you for having us, and good luck, everybody.